let's talk commodities now. That is the other big story of the day. Gold has rallied about 11% this year alone and it's had the best start in 6 years as hedge funds have raised their bullish bets. Joining me now to discuss gold as well as all the other commodities which are in the news today is Keenan, Head of Commodities Research Asia at Societe Generale. Very good talking to you today, Mark. Let me start off by talking, of course, on the movement we've seen on gold. The best starts it's had really in the past 6 years. What really is going on?
Well, it's a number of factors. Certainly, the situation in the Ukraine recently has rekindled some interest in gold as a safe haven asset. I should point out that its effectiveness as a safe haven over recent months and perhaps over the last year has been called into question as its response to several issues that we've seen has been a little counterintuitive. But nonetheless, certainly this year it has acquired an element of strength from Ukraine, and slightly earlier this year a little bit from the emerging market route that we saw in January. Also, some of the price strength has also come as a function of short covering. This was earlier in the year following last year's very steep declines. So that added a little initial strength with some safe haven follow-through. An important thing also that's very important to look at and guided much of the price action last year was the flows in and out of these exchange-traded funds. There are about 35 of them around the world, and they hold physical gold assets, and they've really acquired a disproportionate status in terms of gauging the sentiment in the gold market because of their extreme visibility. They're very easily trackable. And last month we saw for the first time in over a year net inflows into these ETFs and a potential bottoming out in the outflow that guided the price lower last year. So that's added a little bit of a floor, a little bit of a positive sentiment component to the price of gold. And then very slightly at the back of everyone's mind is, of course, what's happening in India, certainly from the outside world perspective, on a possible relaxation or readdressing in some capacity of the import restrictions that were imposed on gold, and also, perhaps the re-export quota that's required. And I think recently I understand that there was some strikes or protests among the jewelry community within India that have gone some way to possibly force the Minister of Finance or for him to comment, that at the end of March, when we get the official trade numbers, there might be a relaxation. So that's added a little bit of additional support as well.
Mark, I want to talk to you about your outlook for prices. We've seen, you were talking about the gold curves. We saw the gold import figures that came out yesterday as part of the trade data. We're still continuing talking about the geopolitical concerns, whether it's Ukraine, whether, the latest happening in China, both in the short and the long term. Do you have a view on where you could possibly see gold prices headed?
Absolutely. Short term, I think the momentum is certainly to the upside at the moment. I wouldn't be surprised if we see prices approaching the $1,400 level. We're well through $1,350 now, certainly with today's action. And so I expect some strength on the back of that. Our long-term forecast for gold, say towards the end of this year, still remains firmly bearish. We see prices down to $1,050 an ounce at the end of this year. And the broader global macro factors, specifically the tapering timeline, the growth in the global economy, will weigh on gold prices as a rising dollar, rising yields, and so on, pressure that. And of course, as yet, we've seen very little signs of any inflation, which was one of the core reasons why many market participants were invested in gold in the recent period as well. So these periods of strength are being treated by many as fresh selling opportunities. and they're also more significantly catalyzing some interest in the producer community, where hedging has been very absent, perhaps for the last 5 or 6 years, as mining companies have had absolutely no reason to hedge their production and have been put under pressure by shareholders not to do so, so that the equity price had a very close correlation to the gold price. But now with the weakness that we've seen, the establishment of hedging mandates within many of these companies, strength is being looked at as an opportunity to hedge production going forward. So that will cap price rallies to a certain extent. And one of our key risks in the gold market is if we start to move lower and we break through recent lows, as we start to cover fresh terrain to the downside, that will increase the urgency of producers to hedge, and that will create a little bit of a snowball effect that could exacerbate price declines to the downside.
Mark, very quickly, before we let you go, brief comments as far as the movement we've seen in crude. Crude this morning has slipped below $100 per barrel. We've seen a price movement of about 1% in this month alone.
Yes, it's the crude markets are very fundamentally driven at the moment with periods of geopolitical influence, as we saw a little bit with the Ukrainian crisis earlier this week and last week. The reason why crude is off this morning is we had the API numbers out last night from the United States that were a little bit more bearish than people anticipated, so it took a little bit of the edge off from an inventory perspective. But WTI has been and is likely to remain very fundamentally driven specifically by the inventory dynamics within the United States. And as we see more efficient pipelines and transport networks and logistics put in place to reduce previous bottlenecks that drove a lot of the price action last year, and to a certain extent the price relationship between WTI and Brent, much of this is now largely behind us. So crude oil is now entering a period of seasonal weakness. We've got a slowdown in refinery demand for this period, so we expect a little bit of relaxing on the WTI as a function of that.